the real all-time high using the government's figures, never mind shadow stats of what the real inflation number is. If we just use CPI as a conservative case, the last time I looked, the real all-time high in silver would be over $200. Let me separate things. You asked specifically, what would it take for silver to hit a new all-time high? Depending on whether you mean nominal or real. Nominal, I think that's within reach just to regular market fluctuations. Real, it would probably take one of these, perfect storms where you have demand picking up and supply constraints at the same time. My outlook for silver going forward is bullish. I am a little hesitant to put more money into silver stocks ahead of what I think of as recession denier capitulation because of the industrial side.
The CPM Group expects silver prices to rise sharply over the next 2 years, driven primarily by increased investor demand for physical silver. Historical data shows that surges in investment demand have been the key factor behind every major silver price spike since the 1960s, including periods in 1978 to 1980, 2005 to 2011, and starting again around 2019. The report emphasizes that while strong fabrication demand and supply trends help create a supportive market environment, the sharp increase in investor buying propels prices. According to Lobo Tiggre, silver's supply is largely tied to industrial metals like copper and zinc, so a drop in those markets could limit silver production. In real terms, he estimates silver's inflation-adjusted all-time high would exceed $200 an ounce. Silver might rise to $100 an ounce in the timeframe of 2026 and 2027. Silver requires exceptional market conditions like rising inflation or an extreme shortage, which might not be its endpoint once it clears all-time highs at $50. Reflecting on past economic shifts, Lobo underscores that silver's unique position as both a monetary and industrial metal sets the stage for significant price gains if demand rises alongside supply constraints. Concurrently, Lobo points out that silver has recently begun to act more like a monetary metal, tracking gold more closely. About half of the metal's total demand comes from industrial applications, while 30% comes from jewelry or silverware, or coins and metal manufacturers. Due to potential recession impacts, Lobo remains bullish on silver but cautious about silver stocks. He suggests any short-term price dip could offer a buying opportunity. Now we present the clips of Lobo Tigre's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I'm very pleased to see that this year silver has started acting as a monetary metal should. It's been tracking gold more closely than copper. And you might say, well, that's a no-brainer. Silver and gold are highly correlated. They're both money. Yes, I know. But last year, silver was tracking copper more closely than gold. And over recent years, if not decades, silver has taken on an increasing industrial use case. Now, this is a mixed blessing, you could say, because that industrial demand is variable. And when it goes away, that does impact the silver to dollar exchange rate, if you will. But what the market taketh away, it also giveth. So when there's higher industrial demand, silver can move up even when gold isn't. The perfect storm is when there's safe haven demand that boosts monetary metals, and there's a supply scare, like bad economic news could do this. And silver, not only is it in itself partly an industrial metal, its number one sources, or number 1, 2, and 3, are all industrial metals. The lion's share comes from big copper mines, these big giant porphyries that have a silver credit, and the rest, biggest comes from lead and zinc. So, and make no mistake, even a pure silver, there's no such thing as a pure silver mine. The purest would actually be maybe silver gold, but the gold would still be a significant component. But most silver comes from, as I say, copper, lead, and zinc. And those metals are important. If it's coming from a copper mine and copper goes down, that silver is not coming to the market. They'll stop mining. If it comes from lead, zinc, the silver might be worth more than the lead and the zinc. But the lead and zinc still matter. If the lead or the zinc makes up 30 or 40% and those prices crater, then that's a huge hit to your margin. So even if silver is doing well, you can still have a problem there. What I'm saying is this perfect storm is when you have some scarce, some safe haven demand for gold and silver, monetary metals, but the same thing, it's economic, is putting a squeeze on supply. And then when you see that, we saw this in 2010. It was what happened partly with the Hunt brothers too, way back in the day, which I participated on as a kid at the time, right? You see this perception, there's going to be a shortfall of silver supply at the same time that investment demand is kicking up. And that's when silver goes nuts. That's when silver went to close to $50 both previous cases. So I'm getting long-winded way to answer your question. What would it take for silver to see a new all-time high? I think a circumstance like that could do it, or almost certainly would do it. If we had a circumstance like that, where there was high demand and supply was seen as constrained, it would break sort of the laws of economics not to see silver soar. And bear in mind that that's just a nominal high. We haven't seen a nominal high yet, really, in all the cycles here that we've been through recently. The real all-time high, using the government's figures, never mind shadow stats of what the real inflation number is. If we just use CPI as a conservative case, the last time I looked, the real all-time high in silver would be over $200. It's not a prediction. I'm just saying, if people are like, oh, 30, mid 30s is high silver. Well, after you adjust for inflation, it really isn't. So let me separate things. You asked specifically, what would it take for silver to hit a new all-time high? Depending on whether you mean nominal or real. Nominal, I think that's within reach just of regular market fluctuations. Real, it would probably take one of these, perfect storms where you have demand picking up and supply constraints at the same time. My outlook for silver going forward is bullish. I am a little hesitant to put more money into silver stocks ahead of what I think of as recession denier capitulation because of the industrial side. That's not a bear case for silver. That's more of I don't want to call it market timing, but it's more like the odds seem to favor a buying opportunity or potential buying opportunity ahead. So what's the rush? So let me see if that happens. And if not, I think there's still plenty of upside.
LoboTiggre explains that the DXY and gold prices don't always move together, as real rates have been the primary gold predictor since 1971. He emphasizes that gold and the dollar rising together often signal a flight to safety, mostly driven by geopolitical events. This movement, he notes, is typically less about economic trouble. When real rates of return in the equity, bond, or real estate markets are negative, people regularly flock to gold as an asset that will maintain its value. Short-term interest rates, as reflected by one-year Treasury bills, bottomed out at 3.5% in 1971. By 1981, that same interest rate had more than quadrupled, rising as high as 16%. In that same period, the price of gold mushroomed from less than $200 an ounce to a previously unimaginable price of nearly $2,000 an ounce. Gold prices had a strong positive correlation with interest rates, rising in concert with them. According to seasoned analysts, including Lobo Tiggre, central bank gold buying is a positive factor. But the real opportunity lies in the underallocation of gold in global portfolios. He points out that the historical average was 2%, but recently it's dropped to 0.5%. If demand even returns to 1%, he predicts it could significantly boost gold investment. Let's get back to the interview.
First and foremost, though, the DXY or any direct measure of the dollar does not correlate very well directly with gold. Markets are forward-looking. So historically, since 1971, when gold was freed from the dead weight of the dollar, you could say, the number one predictor has been real rates, because it tells you theoretically where the dollar is going to be, skate to where the puck is going to be. So it's not so much about the daily wiggles, but where the markets think the value of the relative currencies. And I think gold is money. So I do see it as a Forex trade. When you see gold and the dollar move together, as they did recently, it's usually not about that. It's not about the markets or finance or the economy. It's usually some, as you hint, a flight to safety kind of that drives people into both. And for both to move together, it's usually not a financial flight to safety, like you mentioned, potential economic trouble, but more like the war in the Middle East. So to answer your question, there's sorry, it's a bit complicated. There's more than one thing going on, but no, I don't think it's big money getting ahead of a U.S. recession. I am on team hard landing, but we can come back to that. I do think that it's partly the central bank gold buying that we've seen, very strongly supportive around the world. But more than that, I think the patterns that we've seen over the year suggest to me that if you've ever spoken with Rick Rule, he's probably told you about how over the last 4 or 5 decades, the global average allocation to gold in portfolios worldwide is around 2%. Not, crazy gold bugs packing bricks up to the rafter, right? Just 2%. But that recently, that average has been around 0.5%. Like people just don't get gold anymore. It's a barbarous relic. a pet rock, has taken over that perception of mainstream finance. Under the right circumstances, though, people will see the errors of their ways, the scales will fall from their eyes, and so on. And Rick has been saying for some time that we don't need to have some crazy mania where everybody becoming gold bugs, but just if the world reverts to mean, that would imply a 4x investment demand for gold. Now, I don't know that it needs to revert to mean, even if it just goes halfway back. If it only goes to 1%, that would double investment demand for gold. And in a world such as we have today, we talked about geopolitics. Sorry for the long-winded answer, but this is the answer. We have two hot wars, either of which could literally become World War III. We have all kinds of trouble on the economic side. The global economy is clearly in trouble. The heart of Europe, Germany, is in major trouble. Everybody is, I think, in denial about the actual state of the US economy in an election year. Go figure. But, there are signs of trouble. We just got manufacturing industrial numbers out, all negative today. So, despite the happy, happy, joy, joy narrative, it's not true that there are no red flags in the US economy either. So I think in a world like that, you've got geopolitical trouble that's not going away. Ukraine's going on over 3 years, right? And now this thing in the Middle East is not going away. And it looks like, Israel's going all in. That's a world in which I think not just gold bugs, not just metals traders, not just, people on the COMEX or LME. I think deep-pocketed, not just central banks and sovereigns, but deep-pocketed big money around the world is looking at this and saying, maybe a little bit of gold in my portfolio. Don't need to go crazy. Just 1%, might not be a bad hedge.
The silver price forecast is revised upward, anticipating silver to average $30 an ounce in 2024. A higher price of silver could drive investment in silver-backed ETFs. Supply deficit seen widening in 2024 due to continued decline in silver mine production, providing a tailwind to the silver price. Given the potential for silver's price appreciation and the opportunities in gold investment, how should investors position themselves in these markets moving forward? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.